Oliver, the private equity industry is one of those that has been fairly badly hit by the whole global financial crisis, and I think a lot of them are finding it very difficult to raise new money now. And not only are they finding it difficult to raise new money, but they're also finding it difficult to exit the investments that they already have. Just where exactly is the industry at the moment?
Well, it's in a pretty tough situation. A lot of the funds want to raise more money for their new funds, but it's difficult for them to do that because investors, the traditional institutions and individuals who would fund private equity companies, they're not providing much funding. Fundraising for private equity last year was half the level it was in 2008. So a real drop-off in the amount of new money that's being supplied to the private equity industry. One consequence of that is that the private equity funds are looking ever further afield for new ways of raising money.
Right, a lot of them seem to be tapping regular investors now and trying to get the sort of Main Street investor to come into their private equity funds.
Yeah, the latest is KKR, Kohlberg Kravis Roberts, well-known private equity house in the US. They're launching 2 new funds, one looking at distressed opportunities, another looking at high yield credit. Funds aimed more at private investors, more at individuals. The minimum investment into one of the funds is $2,500. That's pretty small. The minimum investment into a traditional private equity fund will be many, many times that.
Yeah.
This is just a way for KKR to get more money in.
Yeah, but it's always been an industry where it's been very hard to measure the returns, and especially given the enormous fees that these private equity funds have charged traditionally. I think there's a structural shift going on here that the industry itself is kind of refusing to face up to.
Yeah, there is certainly an element of that. There's, I think, a lot of dissatisfaction with the fee structure in private equity. Traditionally, it's been a so-called 2 and 20 system. The funds charge a 2% management fee and then 20% of any profits that are made over a certain level of return. A lot of people think that's excessive and are demanding lower fees for when they go into put their money into new funds.
I wonder whether the industry will actually give those lower fees, though. I mean, because they're making so little money as it is.
In some circumstances they are. Increasingly, one of the other types of new clients that are coming in are sovereign wealth funds, for which the private equity funds are doing more segregated business. They're treating them more as a one-on-one client rather than a traditional investor into the fund. And some of these sovereign wealth funds are getting lower fees because they're putting a lot of money in. And that upsets a lot of the other investors who say, hang on a minute, why are these people getting lower fees and I'm not?
Okay, so private equity is clearly at a crossroads, and KKR's decision to tap the really private investor is potentially a very interesting one for the industry as a whole. Thanks, Oliver.